Let's talk about something that could totally change how millions of us save for retirement. There's a huge policy shift happening right now, one that could open up your 401k to a whole world of investments that honestly have been off limits to most people until now. All right, so let's start with the official line. This is straight from a new White House executive order. Just listen to those words. Carefully vet, safely, prudently. You can just feel the caution, right? They're trying to walk a very, very fine line here. Now hold that thought. And look at this. This quote is from the website of a private investment, and it's all about adventure, new frontiers, and, romance. These two quotes, they perfectly capture the two completely different worlds that this new policy is trying to bring together. It's the buttoned-up, regulated world of your 401k meeting the wide-open, wild west of private deals. So here's how we're going to break it all down. First, we'll tackle the big picture policy change. Then, we're going to zoom way in on a real-world example to see exactly how these things work. And finally, we'll pull back out to figure out what this could all mean for you and your retirement savings. Okay, first up, our story really kicks off with this single government document, an executive order that has the potential to shake up the retirement plans for a massive number of Americans. Get this, 90 million. That's how many of us have a 401k or similar kind of retirement plan. And the government is basically saying, hey, for years, this huge group of people has been on the outside looking in, locked out of the kinds of investment opportunities that the super wealthy and big pension funds have been using for decades. So what are these things we've been locked out of? They're called alternative assets. And really, it's just a fancy term for investments you can't just go and buy on the stock market. We're talking about things like stakes in private companies, big real estate projects, new infrastructure, or even digital assets. So here's the bottom line. The White House is telling the Department of Labor, look, you need to make it easier for the folks managing these 401ks, the fiduciaries, to get into these alternative deals. The whole idea is to give your retirement account a shot at the kind of potentially higher returns and better diversification that the big players have had for ages. Okay, so that's the big picture. But alternative assets still sounds a bit vague, right? Let's make it real. We're going to step away from the policy speak and dive into the actual sales pitch for one of these investments. So meet Rocky Ledge Estates. Picture this, a super high-end luxury resort up in Northern California, complete with private homes and an equestrian center. It's designed for wealthy families and their investment firms. This is a classic example of the kind of private real estate deal we're talking about. And to actually build this whole thing, well, they need cash. $10 million to be exact. That money is slated to go directly into construction, actually putting up the buildings. And here's the deal they're offering. For that $10 million, investors get a 50% partnership stake in the entire resort. And the carrot they're dangling? A projected annual cash flow of more than $1.4 million that gets split among the partners. Not bad, right? Okay, so that's the pitch. But how does it actually work? Let's pop the hood and see what makes this thing tick, because the structure itself is really key to the appeal. It's all built around a legal structure called a RELP. That's a real estate limited partnership. Now, these are pretty standard in the real estate world. You have a general partner who runs the show and limited partners who just provide the cash. But the way they're doing it here, that's where things get really interesting. So how are they going to generate all that cash? Well, their game plan is pretty clever. First, they hook one family with a super low price, like $250 a night. But here's the catch. You have to bring 3 other families with you to fill up a whole house. Suddenly, luxury is affordable for everyone. Once they've got a ton of 5-star reviews, boom, they use some slick AI to raise the prices and go after the big fish, corporate retreats and high-end events. And this right here, this is the heart and soul of their entire pitch. They're drawing a line in the sand. They're saying, we are not one of those typical deals where you buy, flip it at 5 or 10 years and cash out. Nope. They're selling what they call a debt-free dynasty. The idea is that this isn't just an investment, it's a legacy asset you hold on to for generations and pass down. So what's in it for the investor, besides a piece of the profit? Well, this is where the playbook gets really juicy, especially when it comes to the tax breaks and other perks. A huge selling point here is a tax break called 100% bonus depreciation. Now, stay with me on this. This was a really powerful tool for investors that was actually on its way out, getting smaller each year. But according to the materials we're looking at, a brand new law in 2025 just brought it back permanently. So why should you care? Because this is a massive deal. It means an investor could potentially write off the entire cost of building the resort's assets, the homes, the event center, all of it, in the very first year. Instead of spreading that deduction out over decades, you get it all at once. That can slash your tax bill and put a ton of cash back in your pocket, right from the get-go. So you add it all up. You get that giant tax break, you get checks in the mail from the profits, you've got a built-in way to pass wealth to your kids. Oh, and you also get to vacation there for free and use points to travel the world. See what's happening? They're not just selling numbers on a spreadsheet. They're selling a tangible lifestyle asset. Okay, let's pull all the way back. We just went deep on one very specific, very fancy investment. Now look, a place like Archaeology Estates probably isn't going to pop up in your 401k portfolio next week, but it's the perfect illustration of the kind of complex, hard-to-sell investment this new policy could open the floodgates to. So, what does this all mean for the rest of us? Well, it's really two sides of the same coin, isn't it? On one hand, you've got the potential upside. Your retirement account could get access to potentially higher returns, and you could finally diversify into things that aren't just stocks and bonds. But on the other hand, wow, you're looking at a whole new level of complexity. We're talking higher fees, less transparency, you can't just look up the price every day, and a whole different, sometimes greater, kind of risk. And that really brings us to the billion-dollar question, doesn't it? As this new frontier opens up for our retirement savings, are we actually democratizing wealth, giving everyone a fair shot at building real, lasting fortunes? Or are we just democratizing risk, exposing millions of everyday savers to complicated investments they might not be ready for? Navigating that, well, that's going to be the real challenge for regulators, for financial advisors, and for every single one of us.